everyone, welcome. It is 6 a.m., half an hour before the market is going to open on Friday, May 10th. Now, yesterday we were expecting a quiet and muted day, and we did get it. The thing that was a little bit unexpected and that we were wrong about was directionality. We did actually get some directionality in the markets where we moved a little bit higher, but as you can see, it was not significantly higher. It did, however, move beyond the level that we were looking for. Oops, I already had the SPY over here. So what we did do is move beyond this 518 level. And because we moved beyond the 518 level, we traversed this entire space over here and ended up at the 520. And so we were talking about how this 520 to 522 was a region in the past, and we didn't talk about it yesterday, but we talked about it in the last few days. So once we passed the 518, we traversed the entire white space over here and went all the way to the next level, which is what we normally expect. But that was quite a bit of movement right there that we were not expecting. We were expecting us to chop down over here. Instead, we moved up over here. And then we can see that overnight, suddenly we got kind of bullish in the markets. We went all the way up to this 522. So we traversed the entire region again that we've been talking about, except after we hit that 522, now it looks like we're pulling back to this 521.5 area as we're opening up. So that's a lot of movement overnight. We usually don't see this much movement overnight. As you can see over here, well, it's been more limited in the past. We do get directional, we do get movement, but generally we don't get as much as what we saw today. So what are we going to expect? Well, we need to look for catalysts. We need to look for directionality in those catalysts. So let's go ahead and take a look at our futures. So up and random. They're actually similar to yesterday, except in the other direction. Yesterday we said, okay, well, yes, we are down, but we're a little bit on the cusp of beyond random, but we're still in that random range. Well, today it's the opposite. We are up. It is more comfortably inside that random region. We've got about 24 basis points, 25 basis points in the S&P 500, about 20 basis points in the Dow. Yep, 20 basis points in the Dow and about 25 basis points in the NASDAQ. So it is definitely in the random region, but biased to the upside, whereas yesterday was in the random region biased to the downside. Now, yesterday, what normally happens is whatever direction that we're opening, we expect it to pull back towards the previous day's close, and we did that. What happened here? I guess yesterday, as we were talking, it came off. So in any case, yesterday came down and then bounced off of that 516 level and got enough momentum to break through the 518. Today, we are up, and it looks like we might move downwards towards the previous day close. That would be what we normally expect because we have about 70% chance of moving towards the previous day close at the open. But we're so close to this 521, this purple line that we drew right here. Even if it happens, it might just get stopped out immediately and move back up. So are we going to get directional? Maybe. It's Friday. Towards the end of the day, we tend to go towards risk off mode or at least hold steady mode because fund managers are hesitant to add risk immediately before the weekend. So if we do go up, I think we have a pretty limited upside here. 524 might be normal, and let's see where 524 is. 524 would be at the all-time highs. So can we hit the all-time highs today? Yeah, according to our normal levels here, we could, but I wouldn't be surprised if we get stopped around the the highs of this pre-market, which was exactly at this 522.36 level, which we drew a long time ago. Actually, I'd have to scroll back probably at least a week, if not more, in order to find out where we drew this. Oh, actually, let's go to 1 hour. So we probably drew it back over here. See where it bounced down? It bounced over here and came back down. So we probably drew it around April 1st. So about a month and a half ago. And so you see how this honors the levels, previous levels, quite well. So we might that might be our cap today. Only reason I say that is because we're heading into the weekend. Other things that we look at after this may change that analysis. So we'll just see. But for now, based on just purely on the price action over here and the fact of seasonality, the fact that we're moving into the Friday normal institutional behavior, we might just get capped out right here at this 522.36. Let's take a look at our US dollar. US dollar yesterday came down off of that previous support line, now a resistance line, which is what we expect when we hit it. It's coming back down, but today we're up a little bit, undoing a tiny bit. It could continue to move downwards, or it could continue to chop sideways. But basically, it's just undoing a little bit of what it did yesterday, which is interesting because that should imply that the market should have opened down a little bit. If I have a stronger US dollar, I can buy more stocks with it. That means cheaper stocks or cheaper bonds or cheaper commodities, anything that is priced in US dollars, cheaper oil, cheaper gold. So we would expect the S&P 500 to actually be down in the pre-market, not up in the pre-market. So there must be some other force that is overcoming that effect from the DXY. Let's take a quick look at TLT. So TLT, same thing. The TLT is coming down after a reasonably large move upwards yesterday. So that's undoing some of what was done yesterday. So again, that would imply the S&P 500 down a little bit this morning. So the dollar and the bonds are agreeing, and the S&P 500 is disagreeing, which is interesting because the largest market is the currencies market. The second largest market is the bond market. And those two together normally determine the direction of the stock market. So the fact that we have a diverging or disagreeing stock market, at least in the pre-market, is interesting. Those two have to resolve themselves. They don't necessarily have to resolve themselves today, but they do have to resolve. They're not going to stay divergent long term. They're not going to stay divergent over the course of 3, 4, 5 days. Normally, if they do diverge, it's going to snap back pretty much immediately, but certainly within a couple of sessions. So that would imply that either we get a downward motion in the stock market today, or we see the bonds start popping back up and the dollar start popping back up. Again, not necessarily today, but over today and Monday, that's what we'd expect to see. So maybe it'll happen today. And that is another reason for us to believe that that we might get capped out at this 522.36 over here. Let's take a look at our VIX. VIX volatility looks like we are pretty much where we were yesterday. And look where we ended yesterday. We're just at the bottom of this range over here that has been the bottom of 2024. So super low volatility in the current market. We're just at the lows of the year, which isn't really that much higher than the lows of the end of last year, and is actually lower than what we've seen in a very, very long time, actually, since pre-COVID, actually. So definitely low volatility environment right here. we will probably in the weekly market review, we will examine potential forces that could spike this back up. For now, we've retraced this entire region, and as long as we stay below this 550 level we were talking about yesterday, then we're going to consider that normal within the market. We're not going to consider it panic, I should say. Yeah, maybe we have some concern, but it's not panicked concern. And that S&P 500, yeah, it might move lower, but it'll be orderly as long as the VIX can stay below that 550. For now, though, it's super quiet, though that could mean that we slowly drift higher as well. So let's take a look at our CPC. That's something we haven't looked at in quite some time, and we're at 0.85. And let's just establish a normal. We'll just put this point at 0.85 and just see how often did we come down. And then let me just overlay an S&P 500. Just so we can see how everything looks. Did the S&P 500 not show up? There we go. Okay. So here's our line right here. When we go below it, we tend to move higher in the market. Yes. How about at the level? I can't see the dots. Okay, it looks like it's more significant when we not when we hit this level, but when we retrace this level. When we retrace this level, we have a tendency to move upwards. And when we get up, say at about the, I don't know what this level is, but when we're up here or higher and we come back down, that's when you see the market move downward. There is strong correlation here. So the relationship that we normally look at in the CPC is if we hit 1.1 or above and then retrace, then we would expect that market to come down. And when we hit 0.7 and retrace, then we expect the market to come up. So let me just make sure. Let me put a horizontal line over here and just see what those levels seem to be in more recent times. So in 2024, rather than going through several years of history, because 2024 has been acting somewhat more exuberantly than we normally expect. Actually, 2023, all of 2023 was super exuberant as well. So let's get rid of this SPY and see where we drew the line, 1.12, 1.12. And then normally we look at 0.7, and you can see that all of 2024, we never came down to 0.7. And actually all of 2023 doesn't look like we ever came down to 0.7 either. So a better gauge at the moment seems to be 0.85 or 0.80 rather than 0.7. So this is why every once in a while we refresh ourselves and rather than going by a whole ton of history from the past, sometimes recency is a lot more important. So right now, I'm just going to leave these here on my VIX so I know what levels to look for going forward. So for now in 2024, if we hit this 0.85, 0.8, then we can expect a retracement back towards 1. And as we retrace back towards 1, what did we say? Well, this tends to, well, let's just overlay again so I don't put my foot in my mouth. Oops, fix. Okay, so CPC. There we go. Up. And then tendency to move down. This one's not went against it. This one down. Okay, this was too low of a level. We need to be above this line. So down, okay, up. So from here, if we were at 0.85 or 0.80, we would expect it to trace upwards. Right now we're at 0.85. It's not quite low enough for us to believe that we're going to trace back towards the center. So why is it not showing? There we go. Okay, so CPC, we're not quite at a level where we would expect it to retrace back to the middle and imply a higher move in the S&P 500, but we might get there if we get more calls in this market today. Then we could get to the point where next week we would expect that tracement upwards. So this is anti what we just were looking at a few minutes ago in terms of the DXY and the US dollar, implying that we might move downwards. Well, that CPC is okay. Well, we might move downwards, but after that, we have potential to move upwards if we get more calls happening inside of this market. Okay, let's take a look now at our sectors and see what our sectors are doing so we can figure out if this is a broad-based move in the last yesterday, or if it was just concentrated in a particular sector. And not that it was a huge move yesterday, so I wouldn't put too much credence in the sectors, but it is interesting to know where money is moving, just so we can see and we can pay attention. Okay, so just based on yesterday, real estate, home builders. Okay, so this is definitely interesting. So real estate, home builders, utilities right at the very top, same with gold and silver, and retail. What does that tell me? That tells me that there was a move into metals yesterday. That is a safety move, money moving into safety. There is a move into highly interest rate sensitive sectors. So we saw gains in XLU, we saw gains in real estate, we saw gains in home builders. And so that is an anticipation of lowering rates in the future. So actually what that's telling me is that the movement yesterday had a lot more to do with the bonds than anything else. Or actually, I would say yesterday, what was our news? Do I not have my news? Econo Day. So yesterday we had this jobless claim report, and we saw it spike up prices a little bit in the morning. And then we said, okay, well, it spiked this up, not a huge amount. It did increase volatility. Well, it looks like this jobless claims report might have been the focus because there was no other catalyst than people just only had the jobless claims to focus on. And this jobless claims is up. I have more people claiming that they don't have jobs. So up, which means economy is worse. My 4-week moving average went from 210 to 215, which isn't a lot. But if I only look at the initial claims, visually, this looks like it might be somewhat significant. This is 23,000 out of 28,000. That's over 10%, 10% move. So visually, this looks like a lot. But on average, it's not that significant. So it seems like yesterday was an overreaction to this jobless claims number. If I have jobless claims up, what did I say? I think it was 2 days ago. It might have been 3. I said the Fed said that they're going to keep rates higher for longer rather than raise rates. They're saying that they want to slow down this economy. They want to slow down the economy. They want more people with less jobs. They want more people with less ability to chase goods. That's exactly what I was said. I could go back and look at exactly which video where I said it. Well, more people have less jobs. So it looks like we're having if we only go based on this report, which we would never do in terms of looking at the entire economy, but if this is the only report you have and there's nothing else going on in the market, then some managers are going to only look at this report, which would be silly. Implies that there's a lot of new money or new money managers in this market right now. So either junior guys or just brand new people to the scene, where we have higher jobless claims implies lowered economy, implies more probability and more space for the Fed to lower rates. And so we get this reaction in the interest rate sensitive sectors. So let's take a look at, what was I going to take a look at? Interest rate, lower jobs, new Fed Watch. I want to see what changed in the probabilities. Okay. June, actually tiny bit higher, 0.1%. I wouldn't call that significant. Let's take a look at July. Yeah, so ignore now, 1 day move was what ended yesterday. At the end of yesterday, we moved to 32.5. If you remember this, the day before yesterday, when we looked at this yesterday, that number was actually 29. So 29 moving to 32.5. Now today we're retracing a little bit, 30.8, right? We're retracing a little bit. So we're getting a little bit more reason back into this market. So this is showing me that what I just said was probably spot on, meaning that we had an overreaction to that one tiny report that actually didn't move that much on average. It just moved on a single day. Then that is showing that, and now the fact that this morning we've retraced a little bit is showing that, okay, yeah, that's pretty much what happened yesterday. And that means that my S&P 500 should be coming back down, not going up in the pre-market. The bonds are coming back down. So what's going to happen today is, more likely than not, is that all these interest rate sectors should get a little bit of a retracement during the day today, as we get more reason into the expectations of interest rates. So I would expect XLRE, XHB, XLU to be among the weaker sectors today. And then at the bottom, we're also interest rate sensitive stocks, XLK, TLT, XLC, consumer discretionary. Well, and so these are more the QQQ. See where QQQ is? QQQ, which is SMH, XLK, XLY, XLC, for predominantly those sectors, all of these sectors that are right at the bottom right here. So we could get a little bit of a flip. So it'd be interesting to see today, for today only, if we get a reversal. Since we got the reversal in TLT, we got the reversal in the DXY. So far, we are not getting the reversal in the S&P 500. So what'll be interesting to see is, do we flip back around and QQQ or the QQQ type sectors start to lead, the utility and the real estate start to lag? And then if they do it in a balanced way, then this should be flat. And so what's interesting is that even though those interest rate, the XLU and the what was it, the real estate related sectors, those were enough to drive this upwards, because normally the tech companies have such large market cap, it's hard to move against them, especially in the QQQ. But even the S&P, all the FANG stocks, those are the largest market cap stocks. So if they're all moving down, even if you have utilities and real estate moving up, it's more likely that the S&P 500 is going to move down. But the S&P 500 moved up instead. Let's see, did they actually move down, or did they just go up less? Okay, so, well, oh yeah, they didn't move down that much. XLK basically flat. And then the only one down was SMH. So that's why the market was up to yesterday, because yes, these led, but nothing was down basically. So the entire market was up. Today, if home builders and real estate are down, but the QQQ and tech stocks are up, then we could still have an update in the markets. And so then that could explain why the S&P 500 still looks like it's up, even though we're retracing in the bonds and the dollar. Okay, so now this picture is starting to make a lot more sense. So I wouldn't necessarily bet that the S&P 500 is going to move down or have a down day. Choppy or slightly up is still on the table, because right now we're expecting those tech stocks to lead. So to day trade, if you're going to day trade, I would be focusing on tech stocks to the upside, or consumer discretionary stocks to the upside, and then utilities and real estate type of stocks to the downside. So it took us the entire session today to figure out what was going on in this market, but hopefully you got to see a complete analysis and see the relationship between all these different parts of the markets and how they form the ultimate picture. Now we're only 2 minutes away from the market open, so I'm going to end the video here so everyone can prepare for the market open. All right, guys, have a wonderful session. There will be no post-market session today because it's Friday, and we just leave that for the post-market review. I'm sorry, with the weekly market review.